Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, ZINNIA wealth.com, or give us a call. Let's talk about you and your retirement. Actually put something down on paper. Give you something to follow here. 833-368-3680. All right, so there's always a lot of, should I say, guessing when it comes to the stock market, and there's plenty of people out there doing that kind of guessing. So when we talk about how we put our portfolio together, you and I have talked ad nauseum about the 60-40 portfolio. 60% stocks, 40% bonds. It's kind of a generic starting point. It's a rule of thumb. If you say, where should I put my money, Google, how should I allot it? It'll say 60-40. Well, the people at Vanguard are looking this year and 10 years down the line, and they don't see a lot of great things for the economy, apparently, because they're suggesting that people should have a 30-70 portfolio, 30% in the market, 70% in bonds, because they believe the returns are going to be lower over the next couple of years. Do you have any clients that are 70% in the protective area?
No, number one, the math is wonky, number one.
All right.
Because if there's going to be a lower rate of return, why aren't we investing in more equities, number one?
And getting in at the low point. Yeah.
Right.
Okay.
Especially if there's momentum moving forward at a lower risk, potentially, maybe not. But to go into more bonds would be not mathematically sensical to me here.
All right.
So the reason why we've stayed away from the 60-40 portfolio is because if you have 60% of your money in bonds and you really weathered the last 5 years, your average returns are a lot lower than they would have been the 5 years prior to that, because it's based on interest rates and the fluctuation of interest rates. So your bonds can lose money when interest rates change, and then when they change again, they come back up. And so the average rate of return that we've seen historically from bonds is just not your grandparents' retirement.
And right now we're looking at an environment where they're doing nothing but talking about lowering the interest rate.
Yeah. And so when this type of environment takes place in our universe and financial services world, you start looking outwardly to alternatives. So you can look at notes. There's a really stagnation of notes out there, and some firms can really offer some really glorious notes. And it's a way to make money when the market goes up and it goes down. There's annuities. Annuities today are better than ever. The right kind of annuity, though, right? I mean, there's 1,000 annuities, but here at Zinnia, we're only going to offer 5. Okay. There's a reason there's only 5. We're talking about some of the stellar, top of the fold type of annuities. Sprinkling the right CDs and for the right amount of time is going to be key. And then having the right bonds, right? Maybe the muni bonds aren't the best option. And maybe it's more of the exchange traded funded bonds. You can get in and out, and a little bit of a less passive strategy in a 60-40 portfolio could be helpful, but not all your eggs in one basket. We would never say, okay, you're retired. Okay, we're going to follow 60-40 or this 70-30 and wham, bam, we're done. No, that's old school planning. So we don't want that, especially when we're trying to root for a higher rate of return, right? Because how do we get a higher rate of return, still stay safe, still keep fees down, but still be able to play in the fold of the stock market without all the losses? Because people fear running out of money, because when there's big losses in a portfolio, you still need to take your income. So you got to be a little bit different today than we were 10 and 20 years ago when it comes to investing.
It's interesting to me that when you read any article and they talk about, your mix between stocks and bonds, it's always stocks and bonds. They don't give you any alternatives other than bonds. And there are alternatives out there. When people say, Sharice, I want my money to be safe, or I want to be conservative. I've never been a risky person, so I can see myself 50-50. I can see myself 40-60, even 30-70, but having it all in bonds may not be the answer.
No, certainly. So anybody who's, I don't know how many people come in, they're like, oh, we're a private client and we have all the private client bonds. I'm like, that equals to nothing to me. Private client bond portfolio to me is like, okay, so we're averaging 1% to 3%. Maybe some things are tipping a little higher. So you're paying 1% to 1.5% in fees to be this private client. For what reason? Because you feel like bonds are the strategy when they're really not. So you got to get out of that old school thinking. I mean, you can be my private client. We'll keep you out of the bonds. I'll show you what a real private client deal looks like, right? So it's a little tricky, but being able to change with times when times come, and that right advisor that knows how to shift gears when it's time to shift gears is key. Just like COVID, we had to shift gears really quickly, Randy, if you remember that. It was a new strategy.
The economy completely stopped. I mean, what do you do?
And then 2 years into COVID, then we had to change again because the interest rates and the bonds. And 2 years later, the market's moving forward. And now we got Bitcoin. We're kind of shifting gears again. And so being able to bob and weave through these different time frames, I think, is key.
I think this really talks to, we all know, I think, that we need a financial advisor to kind of guide us into retirement and get us set. But it also says a lot toward that person who's with you, who walks with you through this whole journey. Because if you think about it, 25 years ago was the year 2000, and we had the tech wreck. Crazy. And then, in 2008, we know what happened there. We had the major crisis there. In your retirement years, 20, 25, 30 years, we're going to have some of this stuff. And we got to have somebody to walk through it with us. Give us a call at Zinnia Wealth. We do what we call a complimentary retirement consultation. What that means is exactly what it says. It's a meeting that has no charge, no obligation. We're going to look at what you got and figure out what you have done for retirement and what does it mean for you in retirement. What kind of a paycheck does it mean? Are you headed for a tax problem? Are you handled with the estate planning issues and all the different things that go with retirement? Let's get it all locked down for you. Our number is 833-368-3680. Again, 833-368-3680, or online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that and you'll be on your way.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client.